Hi, this is Mark Wahlstrom. Welcome to this week's edition of Speaking of Settlements, a featured broadcast of the Legal Broadcast Network. Well, I've got a quick report for you on some important news. It's one of those things that's kind of a footnote in financial reports and news reports, but it has a tremendous impact for policyholders, annuity holders, and people in the structured settlement industry. On January 29th, just last week, the National Association of Insurance Commissioners had been considering for the last 3 months, ever since the real meltdown in financial markets and capital markets, many of the state, I shouldn't say many of the state, many of the insurance companies, largely represented by ACLI, the American Council of Life Insurers, had proposed and asked the National Association of Insurance Commissioners to consider lessening or revising or kind of tweaking the reserve and capital requirements that they have on certain lines of annuity insurance business. The reason they were asking for that is many of the insurance companies, three very large names in particular, Prudential, Hartford, and Lincoln Financial, are major sellers of variable annuity product that have what are known as market rate guarantees or guaranteed market riders. And without getting into all the details on those particular products, what they do is if somebody buys a variable annuity or an annuity that has a market lock in it, is that if the market goes down 30-40%, as this did, and somebody bought a market lock, their account stays at the amount that they put in some cases with interest earnings on top of it, depending upon the company and the rider. So when the market dropped 30-40%, under these rules and under the regulations that were currently in place for 2008, many of these companies at the worst possible time had to come up with enormous amounts of capital to meet their capital and reserve requirements on these product lines at a time when it was extremely difficult to raise capital, at a time when rating agencies were looking at their credit ratings. So it put these companies under tremendous duress. And one of the things they asked was for the ACLI and other lobbying groups to approach the NAIC and see if they could lessen some of these reserve requirements, with the estimate being that it would free up anywhere from $25 to $30 billion in capital. Well, it looked like this was going to be a foregone conclusion. Many people thought that this was a reasonable accommodation, that many of the reserve or capital requirements were overly stringent. But on the 29th, what ended up happening is the unexpected, as it often does, and the National Association of Insurance Commissioners and the people who were voting on this proposal voted almost unanimously. I think the only state that voted for the proposal was the insurance commissioner from Connecticut, voted overwhelmingly to keep the reserve requirements where they are. And the reason that they stated, and I thought it was a very good reason, was they felt at this point in time that it was the wrong message to send to consumers, to policyholders, to annuity holders, that there was going to be a lessening in financial safety and that there was going to be a lessening in the reserve and capital requirements. Now, as you know, I've had several podcasts, I've had several editions of Speaking of Settlements, where we've discussed this very issue, where I keep telling people to remind them, particularly policyholders, annuity holders, is don't confuse financial ratings, don't confuse earning reports, don't confuse stock prices with the solvency or the safety of your particular product. What this reserve requirement would have done was lessen the need for insurance companies to put money away for capital reserves to meet the obligations that they're statutorily required to meet. In other words, to pay their insurance claims, to pay their annuity benefits, to pay their pension benefits, the things that life insurance companies are supposed to do. And I don't know all of the nuances, and we'll put links to the NAIC decision here on Speaking of Settlements and on our website. So if you want to find out more about it, you're going to be able to go to it and go right to the source and dig right in and get that information. But the important thing for people to remember here is that I think the insurance commissioners, because they took 3 months to consider it, because they really looked at the evidence, they realized these companies are not under the strain, they're not under the duress that they originally thought that they were, that this is not an unreasonable reserve or capital requirement for them to meet. and that it does send a very important statement, and it is a very important, tangible demonstration of the fact that insurance companies, unlike other institutions, unlike many of the banks that have failed, unlike brokerage firms, hedge funds, that they take their responsibility to policyholders and to their customers extremely seriously about meeting their claims and protecting their assets. So this is very good news. It's very good news for annuity holders. It's very good news for structured settlement recipients. It's good for people who have pensions and life insurance. I think the Association of Insurance Commissioners is to be commended in this case, that they really did take the time to look at and examine it, to look at the necessity of it, and to not get stampeded by the panic that was really occurring in November and December, when people didn't really realize or didn't understand what the ability was going to be to raise capital. So once again, great news for policyholders. The product has been strengthened. The stability of these companies, again, their credit ratings have been upheld. The product that we sell and offer here in the structured settlement business and the settlement planning business, which is the court settlement structured settlement annuity, goes by several different names. But the guaranteed payments that we make, these payments, these obligations are going to be honored, and the Association of Insurance Commissioners, I think, is to be commended to make sure that that money is always going to be there, that the reserves are going to be met, and that these obligations to policyholders and insureds are going to be honored. So good news. Go to my blog at thesettlementchannel.com. You can also find us on speakingofjustice.com. We'll have more information on this decision, but great news for the settlement industry. We'll be back here again next week on Speaking of Settlements, a featured broadcast on the Legal Broadcast Network.